And welcome back. Thank you so much for joining me in today's video. As you guys can see, I have a special guest, which is Jim Black. Thank you so much for joining me in today's video, Jim.
Happy to be here, Jason. Thanks so much. A lot going on today with some announcements. So glad to be on here.
Yeah, absolutely. So the reason why I brought Jim on, obviously, he's a great friend. He's been on my channel several times before, but the FHFA, which is the regulation body of Fannie Mae and Freddie Mac, just announced yesterday on November 28th an increase in the conforming loan balances. And I want to kind of talk about the impacts for home buyers right now and how it changes when you're going from a conforming loan to a jumbo loan. So maybe briefly, you can kind of describe what this really means, how this is impacting buyers right now.
Sure, absolutely. So right now we're getting into the holiday season in 2023, and this time of year, FHFA, which is a federal housing finance agency, is regulated by the government to set the new loan limits for the following year. How they do that is they look at the last 2 years, third quarter average home price in each specific county. So you can imagine there's thousands and thousands of counties throughout the United States. So what FHFA does is sets the bar for conforming loan limits, and they look at that average difference of year over year appreciation in home sale prices. That appreciation difference for 2024 and the new calculation of loan limits is 5.56%, which means all of the loan limits are going up by 5.56% for conventional loans. That doesn't necessarily mean you qualify for 5.56 more percent of a loan amount. We still have to make sure that you have the ability to repay, but it does create more flexibility in the amount of loan you can have. And that should help with the increased purchase price be able to afford more home.
Absolutely. So just because the conforming loan limit increase doesn't mean that you're suddenly going to qualify for that amount. So
It does
yeah,
not,
good
but
point
what it
here.
does is it gives the ability for buyers, though, to have more bandwidth in the loan size to be able to hopefully buy at a higher price point. We see a lot of times in the marketplace that the
Absolutely.
conforming loan limit will be stuck at a certain dollar amount, and then the markets above that, you can't get financing. So this increase of 5.56% helps us out dramatically in the ability to get more people into homes. And in some counties, for example, that loan limit now is almost up to $1.2 million, which is pretty crazy. So again, a conventional loan size being $1.2 million is pretty wild to think about. And again, no matter
Yeah.
what you do as a professional and work with local professionals, know that just because you can doesn't mean you should. So you always want to take
Yeah.
that in consideration, that these changes are meant to be positive. At the same time, you still have to qualify for the debt. So it's great
Yeah.
news to help create more loan limit size, to create more, hopefully, volume or velocity in transactions, but it's still specific to each county. So FHFA announced their loan limits being 766,550, which is
That's
the
right there. Yeah.
conforming conventional loan size.
Right.
In certain
That's an
areas
increase of
throughout the country,
$40,000 from this year's limit. And then, right, like you said, it's because home prices increased by 5.56% between the third quarters last year through this year.
yep. And the previous year, it went up 11.6% roughly. So just
Wow.
know that there's still, as appreciation happens, the government wants to make sure that the guidelines are set up to help people be able to adjust their purchase price to catch up with those inflated home value prices.
Yeah,
I must,
absolutely.
yeah, and I must make sure that we declare there is actually another bucket of conventional loans. You have conforming conventional loans, which is mentioned in FHFA. You also have high balance conventional loans, which are specific to each county. And that's where they take 115% of the median income to adjust the loan sizes appropriately. So, for example, where we are here in California, there's a swing from Sacramento County of about $750,000 to the Bay Area in Silicon Valley or Santa Cruz or San Francisco to about $400,000 more in loan size available. So not only is it set as a national standard, it's actually even more hyper specific to the county that you're in. And there's a lot of
Absolutely.
great
Yeah. It
charts
varies
out
by
there
the
that we
area
can
you're
share.
looking to buy in. Right.
Exactly. So no, like you could have conventional loan sizes that are different in a 5 mile radius from where you're looking. Do you mind pulling up that chart, Jason, the map that we shared earlier? Can you
Yeah.
pull that one up?
Yeah. I'm trying
That
to,
map is
sorry,
going
I'm
to
trying to pull up
show if you're a buyer or a homeowner or even a real estate professional, this map is very important to understand because it will truly share with you some of the things that are really important to think about when you're doing these things. So Jason's going to pull that up now. And for
yeah, there you
example, we're
go.
looking here in the Bay Area in California. You'll see
Yeah.
that it's color coded specifically to the loan size. So if you look in the orange, for
Right.
example, that loan amount limit is about 1,149,825. Jason, can you toggle from Santa Cruz County to the yellow,
Yeah.
which is the next
Absolutely.
one down?
Yeah, this is pretty wild. So here's the Bay Area right here, right? So you have
Yep.
San Mateo, San Francisco, all these areas in orange are at
Yep.
1.15 million. Santa Cruz, what Jim was talking about, the same loan limit as other Bay Area counties here. When we just go a little bit south, it decreases from 1.15 million to $920,000. Pretty wild.
Significant, right? So that's over $300,000 or $200,000 change plus to whatever the buying capability is of that borrower. So think about properties that are on these county limits. If you're a homeowner looking to sell, you should be working with your local real estate professional to realize, hey, if I price myself out of this market, I won't get a lot of traction. In the same regard, if you're a buyer, you have more buying power in Santa Cruz County than you do in Monterey County because that loan limit is higher. Doesn't mean you necessarily should buy, with a bigger loan, but it just lets you know that you have more capacity. So if you're looking at a house, for example, that's in Monterey County at $1.2 million, we know that the down payment's going to be almost $300,000 of down payment or something like that. If you go a county higher to Santa Cruz County, that down payment is going to be very limited. And just for example, in Santa Cruz County or any of those Bay Area counties, 5% down payment on the new loan limits gets you to a purchase price of $1.207,000. 1207 is the new purchase price you can do with 5% down to the new conventional high balance loan limits.
To get you
Now,
to below the jumbo. Yeah.
this map is really good to share as a homeowner and as a buyer so
Yeah.
that you know what you're going to be looking to qualify for and where you're going to look to buy. So if you're not
Yeah,
specific to
exactly.
a county, look around. Maybe find that driving another 10, 15 minutes would save you a lot of money.
Yeah. And I'll provide a link in the video description below for this article and this map as well, because they share all the counties nationwide. And of course, I have people watch my videos nationwide as well. But if you're in Sacramento, the loan limit just increased to 766,000. Placer County, same, as well as El Dorado and Amador, for example.
And again,
So
those
if you're looking
counties
to,
that you see that are in the colors on this chart are high cost counties where the average
yeah,
price of a home is over 120, 115% of the average income. So that's why you see these ones on the coast here. Normally, coastal properties are more valuable because of locality or professions. And
mhm.
that's why you see that there's a difference. Jason clicked on the 766 and change number in Sacramento in the gray area, and these other areas have higher limits. Remember, these are high balance loan limits. This is not necessarily jumbo. And that's another category we can cover also to understand the difference between the jumbo loan, a high balance conventional loan, and a conventional conforming loan limit.
Yeah, so maybe we can. I mean, I'm just kind of scrolling around the map here. So everything in gray here is the loan limit is, to be exact, 766,550. Everything else in shaded is actually higher than that. The more expensive areas, obviously in the Bay Area, Los Angeles, a couple of counties here in Utah, as well as some counties in Colorado, Wyoming, Idaho as well. Then we have over here, we have Virginia, then we have New Jersey and New York as well. So interesting to see this. So Let's kind of take a step back here, and again, I'll provide a link to that map in the video description below for buyers looking to purchase a home. If they're kind of close to that loan limit, now we're seeing the loan limit increase. How would the rates vary today compared to conventional loans, and also the underwriting standards as well?
Great question. So, portfolio, I'll start with the guidelines first of all. Portfolio lenders make up their own guidelines. Most banks that offer portfolio loans are more conservative than mortgage companies. Mortgage companies are regulated by one or two different regulators. Banks have probably between 4 and 8 different regulators throughout the product lines that they offer. If you're doing insurance, mortgage products, brokerage products, checking, savings, money markets, all the regulators are different depending on those products. So a bank normally is more conservative on their portfolio guidelines than a mortgage company who's regulated by less different entities. A bank has to take the worst common guideline and be conservative based upon that, or have what you would call overlays. So, in some instances, a portfolio lender may be more restrictive in their guidelines. They may require more down payment or more reserves or a higher credit score, but they may be a better rate because they have money set aside that they can offer at 6.5% versus 7%. So, there's some trade
Mhm.
offs there around portfolios. Does
Okay.
that
Is
make
that in
sense?
general that it's a harder to qualify for a jumbo loan, and in general, right now you'll still get a better rate though?
Yes. And a lot of it has to do with the supply and demand also of capital. That banks lending out
Mhm.
money at a cheaper rate means they have a lot of supply. They have a lot of people that have put money in savings because as the Fed raises the interest rates, people are more likely to save that dollar versus spend it because it costs that much more to spend and they can make that much more in savings if they don't spend it. So what you're seeing is there is a surplus of supply at these banks. That coupled with the fact that housing inventory is very low, right? We see historical lows over the last 25 years. These banks and lenders are frothing at trying to find ways to deploy capital. They may look at
Mhm.
other channels of business, maybe car loans or student loans or other loans. But either way, it tells me that there's a lot of capital available. And as we see more velocity or volume come on the market, it should mean better rates for everyone across the board. So a higher conventional loan size helps create more competition to be able to have consumers have more choice. And again, no matter what you do, you have to qualify for this stuff. So please know, just because mortgage limits are higher does not mean I qualify for more. I'm going to reiterate that a lot because again, people equate, oh, I can get that much more of a loan amount now. It means that much more of a payment. It means that much more of a qualification. So just be aware for sellers, I think it's actually as beneficial because now they know if they're in that sweet spot of the purchase price, they just got a whole nother audience of buyers that can now buy 5.56% more of the inventory that's available. So
Yeah,
it's
if
really
they
good
don't
for sellers.
qualify for the jumbo limits and want to stay below that, more strict underwriting guidelines. Yeah.
Exactly. So those are challenges. And again, in each market, there are products and services offered from great loan officers and companies that have first-time homebuyer programs to down payment assistance programs to first and second loan combinations. Right? Just know that a loan officer should give multiple solutions, be able to provide multiple perspectives, and then the consumer, along with their trusted advisors, should make the best decision for their needs, right? What are the objectives of the client? That's what it all comes down to. And
Yeah, I
banks,
love that.
unfortunately,
Rather than saying now is the time to buy, Jim, or now is the time to sell, or every day is a great time to buy or sell a house, right?
I will give you a confession. Every single house I've bought in 22 years, I've bought I think 17 homes now. I know it's way too many. I've
What?
bought
Really? I
them
didn't
in
know that.
Yeah, I bought them in October, November, December, or January.
How
Why
funny.
did I buy them then? Less
Less
competition,
competition. Yep.
less competition. And right now, I do agree if you're going to buy in the long run, it is a good time to buy. If you're trying to buy and flip something or have a short-term hold, it's not a good time. But if you're going to hold in the long run, you're probably buying with less competition today. One of my dear friends, Barry Habib, had a stat he put out that every 1% lower in interest rate, 5 million more renters can become homeowners. 1%
Yeah.
difference equals 5 million more potential buyers. And if there's only less than a million homes available right now in November of 2024 or 2023, that means 4 to 5 times as many people potentially per property looking to buy when rates go down 1%. What happens if they go down
Yeah.
2%? That's 10 million more buyers. So again, I don't see supply catching up with demand, and I do see rates going down in the second to third quarter next year. So I do think if you are set on a long-term plan, it is a good time to buy because you probably will be getting the ability to refinance in the next year at a lower interest rate, which means that high payment you're qualifying for right now will probably be less in the future, which is almost like a bonus to buy now. But again,
Yeah, I
each
think
situation
you
is
make a
unique.
valid point with like I mean, I think there's a lot of people who are waiting for rates to come down and they think they're going to get a screaming deal on a home. And obviously the future of our market depends on rates, but also inventory. And so when rates do decrease, of course, that causes more people to get off the sidelines to buy houses. That increases competition. And then we see another rise in prices again. So I always tell people when they ask me, is now a good time to buy a house? I always tell them the same answer, which is have long-term time horizons, 7 to 10 plus years, have a stable job, an emergency fund, et cetera, rather than trying to time the market, which is very, very challenging to do. And if you're a buyer waiting for rates to decrease, well, when rates decrease, of course, it's going to increase competition. In my opinion, the direction of our market is going to depend on rates, unemployment as well, and how many people decide to list their houses for sale. So it's really anyone's guess, to be honest.
Yeah, and also
Um,
we have a huge group of seniors that are now retired and they're figuring out if they can physically, emotionally, and financially stay in their property. A lot of people are trapped right now. There's so many people out there that should get reverse mortgages, for example, that can't because the interest rates are so high that they don't qualify. So it's just a really interesting time right now where I believe interest rate reductions will be very beneficial for homeowners more than it will be for buyers.
yeah,
Let me repeat that. Homeowners will have a better advantage when rates go lower than buyers because homeowner can restructure their debt to make a long-term decision to stay in their property, consolidate debt, pay off credit cards, student loans, car loans, whatever it might be, to help them readjust their priorities for the long run. Buyers will probably face fiercer competition. And the reason why is because there's it's we're not in a perfectly competitive market. Supply of housing cannot catch up in real time with interest rate fluctuation, right? If you
yeah,
think
for
about
sure.
pure economics of supply and demand of product. If I owned a burrito shop, for example, if I had more demand for burritos, then I'm going to go get more beans and more rice and more tortillas, and that's readily available. Well, guess what? Housing is not readily available to create or not create overnight, right? So you don't have the ability to build these products in time for the amount of demand that will be coming up. So I
Yeah,
believe the
yeah,
shortage of that housing will help sustain the values today. I don't see values going down as much as people think they may. I see people making better long-term decisions. And the word mortgage, it stands for until death. So people are going to keep mortgages for the long run. And that in some countries, that's as long as 30, 40, or 50 years, not 5, 6, 7 years. So I think you're going to see less movement, people making better decisions to renovate and stay in their properties or decide that it's important to buy when no one else is looking to buy. A lot of people can take advantage of markets in any industry. When everyone's going this direction, sometimes it's not bad to be going the other direction or go against
yeah.
the grain. So
I
that's
hear
just,
you.
that's one of the ways to look at where we are today.
Yeah, I know you and I both have rates less than 3%. So like, we don't have a lot of motivation to sell. And I know it's a good position to be in. I recognize that there's a lot of people out there looking to buy a house that are very frustrated, to say the least, over the past several years, seeing the rising rates and prices and thinking, am I ever going to buy a house? So challenging market, to say the least. Thank you so much for joining me, Jim, in today's video. And for anyone who wants to reach out to you, if they have questions, want to apply for a loan, how can they reach out to you?
Yeah, it's really easy. My website is super easy. It's www.meetjimblack.com. Like, nice to meet you. And thank you again, Jason, for your time. Next year, 2024, like I mentioned last time on our YouTube video series we did, it's the year of affordability. And affordability, sometimes people get stuck with first time home buyer affordability. I'm talking about overall affordability of your lifestyle. And that's
Yeah.
a concept that we all need to grasp more and more every day to understand what it costs to live the lifestyle we want, and make sure that we have the right tools, the right resources, and the right advisors to help us make those decisions. So thank you again for your time. Have a great holiday season, everybody, and I look forward to seeing you guys soon.
Thanks, Jim. Yeah, thank you so much for watching today's video, guys. Like and subscribe. Of course, share this video with anyone you feel may benefit from the video. Hope you guys have an awesome day. I look forward to seeing you in the next video.